All right. Well, let's go ahead and get this show on the road. So happy Monday. I think that's the right day. Hope everybody had a great week last week. Hope you have a great new year. Um, this is the time of the year that things can either be really, really busy. Sometimes there's that end of the year kind of crunch, trying to close a bunch of transactions to get people in houses, to get homestead filed before the end of the year. And sometimes it's slow. It's kind of different. But I think no matter if you're busy or slow right now, it's always a good time to kind of give thanks to those of that impacted your business positively. So thank you all from everyone at Cross Country for your continued support of our businesses. We had a great year this year. We did a little bit over $200 million in production with our team. So super excited about that. It seems like 2026 has incredible potential for a number of reasons, and we're going to talk about that a little bit today, what we think 2026 will look like. It's also a great time of the year to kind of finish up your business plans, but business plans are completely worthless without action. So I'll tell you guys a quick story. Um, One of the best lessons I ever learned in my career was from a coach in the core training named Josh. And we had a homework assignment that was due, and I didn't do it for whatever reason. And I, made up the excuses, this, that, and the other. And he said, Mike, the only reason why you didn't do it is you didn't make it a big enough priority. So that lesson has stayed with me forever because if we want something done, we need to make it a priority. And so the reason why most people fail to execute on their business plans is because they don't prioritize whatever those tasks are that they've decided they need to implement in the new year. Um, so that could be more prospecting, it could be better systems, taking care of your past client database, reaching out more consistently. But whatever those tasks are that you have prioritized in your business plan, the most important thing that we can all do is take action on that. So, want to talk about the market a little bit, but before that, I want to talk about 2026 and some predictions. And I want this to be as interactive as possible. So, the chat is open, and I'm curious to get some feedback. Okay, so question number one, because you know that I'm not afraid to talk about how the political climate will impact the real estate market. So, a presidential candidate, okay, after their first 2 years, kind of the midterm elections, what is generally speaking their number one priority? What's their number one priority heading into the year of the midterm elections? And that's going to be all over the news over the next few weeks as we head into 2026. It's a midterm election year. So the party in power, in this case, President Trump, what is the party in power's number one priority? Okay. Um,
Saturday.
Dave Bowen with 100% the right answer. Okay, so Dave said holding Congress, and Jennifer Fanning said the same, and Brent and Andre said the economy. So Dave and Jennifer, I think you guys are 100% spot on. Whether it's Donald Trump or Joe Biden or Barack Obama or whoever, generally speaking, the president after their first 2 years, their number one priority is getting reelected, and not themselves getting reelected, but getting their party reelected because the House of Representatives can flip every 2 years. So think back to when Barack Obama was president. Okay. What was the biggest, um, like the biggest bill that was passed during Obama's 8 years? Like if you look back and said, what was the one bill that was passed or the one policy change they enacted?
The
Okay,
Affordable Care Act.
Obamacare, right? Obamacare. When did Obama pass Obamacare? In his first 2 years. Okay. Why didn't he pass another major milestone bill like that after his first 2 years? Because he lost the House of Representatives after the first 2 years. He had all three branches of government for the first two. They passed Obamacare. They didn't need the Republicans to support it. Democrats could have pushed it through with no Republican support. And President Trump doesn't have quite that degree of power right now because the margins are so thin in the House and the Senate. So Obama could push all in on Obamacare, which was what he really wanted, right? Affordable Care Act, knowing that it might cause him to lose the House after 2 years, which is probably what it did, right? Republicans that were against the ACA really came out in droves and they flipped the House. And honestly, divided government, if you look back in times um, when like when did we last balance the budget? We last balanced the budget in the 90s when the Republicans had the House and Clinton was the president. So divided government isn't necessarily a bad thing. I think both parties tend to take a little bit too much power when they have it all and go a little bit too far one way or the other. But Trump, okay, so he's had 4 years, then he had a break, and now he's got his last term, and it will definitely be his last term. Okay, no matter what some conspiracy theorists think or what jabs he might put on Twitter, right? He has 4 years left. But if he loses this November, he really has 6 months, 8 months, 9 months left to really enact changes that are high priority items for him. So, um, the first answer to the question was, what's the political climate? What's their priority? Getting reelected. 100% agree with those of you who said that. The second piece that is, how are they going to get reelected? What would be the one thing that could help Trump keep the House for another 2 years, which is, again, his number one goal, just like any president's number one goal after 2 years? What could cause that to happen? Yes, it's the economy. But if you look at the economy right now, like the stock market's booming, it has been for years. Unemployment rate is pretty low. You have this tech AI revolution happening. It's really affordability, and there's still some stings of inflation out there. And even if inflation has cooled to like a month over month or year over year level, that's getting back to being comfortable. If you look at how much inflation has gone up from 2020 through today, inflation could be flat for 12 months and things would still feel expensive. And so, first prediction, like what can you expect Trump to do in the next 6 months? Anything he can to improve affordability, okay, which means pushing interest rates down. So this week we get the Fed minutes, which is from the December Fed meeting. They cut a quarter of a percent. They'll probably pause and not cut again in January. It'll be really interesting to see what the Fed minutes say from last month's meeting that gets released this week. And what tone is the Fed taking? Because they're probably not going to cut in January, but the reasoning behind not cutting will be interesting to see. And at some point, and we've been talking about this for a while, Trump will nominate a replacement for Fed Chair Powell, and we'll have a new Fed chairman in a few months. And when Trump makes that announcement, that person will be the quasi Fed chairman, even if they won't hold the seat yet. Their opinions, their comments, their interviews, their policy positions, what's expected that they will do will really be more powerful than anything the current Fed chair says. So we could get an announcement on a new Fed chair literally any day now. So December could be the last meeting that happens before a new Fed chair is announced. And so this could be Jerome Powell's last Fed meeting, a few weeks ago. This week, when the minutes are released, could be the last time we get minutes and commentary of the Jerome Powell-led Fed. So what do we expect Trump's new Fed chair to do? Likely to be more dovish on interest rates. Dovish means more likely to cut because Trump wants rates to come down. And that's really been a big priority of his since he was elected and took office in January, that he wants to push rates lower, improve affordability. It's happened to a degree, but probably not as fast as he would like. If you read Twitter, he wants rates at 1%, right? Um, I also think it's interesting to say that what did Trump do before he got into politics? He was a real estate developer. How do real estate developers build and develop properties? They get their money two ways. They get their money through partnerships, so they raise capital with investment partners, and they get their money from banks. And so the real estate developer and Trump, the last 40 years or so of his career as a real estate developer, what has he wanted? He wants rates as low as possible, just like any real estate developer or home builder or mortgage loan officer or real estate agent, because it's good for his business as a developer, good for our business in real estate and mortgage lending. And so I think he's more apt to push for lower rates because that's what he did in the private sector as well. Um, that all could be very positive for us. And I think rates will continue to drift lower. The signs of inflation cooling are there. Unemployment has ticked up a little bit. The jobs market's been weak. So it feels like we should continue to see rates drifting a little bit lower. I think you'll see your interest rates in the fives at some point in the first quarter. They're already getting there on government loans. But we've got to make sure that inflation doesn't spike again. And we all remember what happened in the fall of 2024. Interest rates were coming down, the Fed was cutting, inflation spiked, and then rates shot up a full point. So um, I think the president will get his wish on rates moving lower, no matter what policy they implement. You know, the economy is bigger than the president or the party in power who's in Congress. The economy is going to move no matter who's in charge. And we are kind of moving into a market where inflation should be cooling. And that's not really a Republican thing or a Democrat thing. That's just an economic cycle thing. Um, I think you're going to see interest rates drift a little bit lower. And the only thing that would change that is if he pushes too hard and for rates to be lower in the face of maybe a little bit of an uptick in inflation. It seems like the market has absorbed most of the tariffs, and those haven't been as inflationary as feared. And we've talked a lot about that. And so I think that the kind of tariff talk and scare of the tariffs is probably a thing in the rearview mirror, which is a positive. The market settled down. Um, I think you're going to see continued pressure on unemployment. AI, you know, we've talked about that a lot. This AI revolution is great for companies, great for efficiency, not great for men and women who have jobs and whose jobs could be not necessarily replaced, but maybe, you know, a company doesn't hire 10 people, maybe they hire five because tech allows them to use computers to be more efficient. And so I think it's going to take some time um, for that to, you know, to the economy to adopt to that. If you think about, you know, many of you were alive when like telephone switchboard operators were a thing. Like if you're, you know, 30 years old, you probably don't know what that is, or like what a rotary phone is. But, you know, a switchboard operator, you know, back in the day, I'm not picking fun of you, Dave Bowen. I see your comment. I was alive, I think, as well. My mom had a rotary phone in her house, I think, until like 2010. Um, so, but you know, telephone switchboard operators, that's a great analogy because, you know, years ago when you called someone, you called into a switchboard and they connected you to where you were going, and that obviously is a job of the past. Um, and heck, landlines are a thing of the past these days, right? But after a period of time, when those positions were slowly eliminated as technological advancements happened, those people found employment. And so that'll happen with AI. And AI will ultimately probably be a good thing for us long term, but it's going to cause some pressure on unemployment, I think, for a period of time. So I don't think unemployment's going to come down. I think it'll stay the same to maybe uptick a little bit. And that's probably because of tech replacing jobs more than anything. Um, so if interest rates come down like I would expect, what would you expect the number of home buyers in the market to do? Do you think that would cause the number of home buyers to increase or decrease? So lower rates, is that going to bring more buyers into the market
More
or
buyers.
fewer buyers? More buyers, right? Significantly more. So I'm going to share a chart, and the only chart I've really got to share with you guys today. Um, and this stuff's been floating around for a while. I'm not sure how much I really like this. I don't know if I trust the source of the data as far as how accurate is it, but you guys have seen this float around. Redfin's been putting this out, and this is the number of sellers in the market, which I think is probably easy to track, you know, pulling MLS data. Um, I'm not sure how they track the number of buyers. Like if I'm out looking for houses, like how does somebody know I'm looking for houses? You know, but um, anyway, there's some way they compile this data, and they have going back to 2013, and you can see that, you know, the number of sellers far exceeds the number of buyers. And whether that 1.9 million sellers and 1.4 million buyers is an accurate number, and everybody in the headlines is like, there's 500,000 more sellers than buyers. I don't know if any of us know those numbers to be 100% accurate, but what I do know is that the overall idea that there's more sellers than buyers is true. You know, to what degree, to how many, hard to say. But that trend, I think, has been increasing over the past few years. the number of buyers, if we look back through 2023, it's come down a little bit. It's a couple 100,000 maybe using this math. That hasn't changed a whole lot. The number of buyers actively looking has been relatively stable the past couple years. The number of sellers is what's increased, and so that gap continues to widen. Um, when I look at this, I see opportunity, because if I'm buying a house with a lack of competition, there's deals to be had. And so this data, I think, is something that is really important for us to share with both sellers and buyers. Sellers, to know what they're up against in this market, and they might have to be more aggressive on price or concessions or repairs or things like that, and buyers to show them that there's great opportunity in this market with a lack of competition. I would expect as rates drift lower that these numbers start to shrink. And when they shrink, that means less opportunities, fewer deals to be had. Um, this gets posted every few weeks. I see it on X. It's shared. Um, you can see both trend lines. The number of sellers and buyers have kind of drifted lower in the fourth quarter. That's not unusual. That's seasonal. Um, I think what's going to happen in the first quarter is that buyer percentage is going to tick up. Um, I would imagine, and I think for all of us, a huge opportunity in 2026 is to reconnect with buyers that we had engaged with in some capacity over the last 12 to 24 months who have taken themselves voluntarily out of the market. I'm going to rent for another year. I'm not going to sell my house. I'm going to wait. We've all probably had that conversation 1,000 times. Our team will spend a lot of the next 2 weeks re-engaging with those people, sharing this chart and data like it to show them the opportunity that market in 2026 could present to itself. Um, and I think that market's going to shift. I think the first quarter of 2026 will probably feel a lot like the fourth quarter of 2025. But I think the second and third quarters of next year, expecting that interest rates will drift lower, will feel like a more normal balanced market. And so I think kind of with my prediction hat, um, when is the best time to buy if you want to quote unquote deal? Probably in the first quarter. I think second or third is going to feel more normal. And Circling back to kind of some of the things you can expect from Congress and the president, they have floated a lot of ideas out there, most of which that I don't personally think are great ideas, the 50-year mortgage and things like that. Um, I would expect more things like that to be floated over the next few months to see what the public grabs on and says, I like that one. I've seen things like eliminating the capital gains tax. So on a primary residence. So now there's the 250, 500,000 threshold, single or married filing jointly where you don't pay capital gains tax on on profit of a sale of real estate. That keeps some people from selling because if you bought a home in a higher price point area in 2020, 2018, you might exceed some of those numbers right now with appreciation. And so I've seen some proposals floated where maybe it's an income threshold that if you make less than X, there's no capital gains. I've seen proposals that it goes to $1 million of profit. I've seen some things that it gets eliminated altogether. That'll be interesting to see what happens with that. Um, the other thing I think you're going to start to see a lot of the tax cuts. So, what was Trump's big kind of signature legislation? Like we said, Obama's first year was the ACA. What was Trump's big signature legislation this year? His one big focus in his first year in office. Yeah, anybody know what bill that was?
The big beautiful bill.
The
Okay.
big beautiful bill, right?
Yeah.
I think I don't know why they, it's so crazy like how they name these things, like it's like the big beautiful bill. That's like such a Trump name. Yeah, Bob Schoeneman, the BBB. A lot of the uh policy changes in the big beautiful bill um are related to tax cuts, and most of those go into effect in 2026. I kind of think there is some strategy behind that. Like if you can cut people's taxes 6 months before or 9 months before the election, the midterms next year, they might feel better about their economic situation. There's probably some strategy to that. I feel like most politicians kind of have a reluctant strategy on bills like that. But I do think that our customers will probably feel um, a little bit less pain in their pocketbook with some of those tax cuts because they really don't go into effect until next year. So that'll be something interesting to watch as well. Like, so on our team, like things we'll talk about is like, your take home pay, right? Like if your take home pay is increasing because your taxes are less, if you've got a couple $100 a month more to spend. Like I talked to a client this morning that's a first time home buyer. He can qualify for more than he wants to spend, like many, but $1,800 to $2,000 is really his comfort zone. And he lives in Claremont, which, if you're not in Orlando, it's kind of the west side of Orlando. And he really wants to be there, but there's not a house within the area he wants to be in, to keep his payment within budget. And so he'd have to go like 30 minutes north or south, and he just really doesn't. So he's considering renewing his lease, right? It's a conversation we've all had probably dozens or more times over the last year or two. Um, if his taxes were cut and his take home pay improved, maybe he is comfortable spending 23 or $400, not $2,000. And that extra $300 or $400 a month, maybe that gets him a couple, 30, $40,000 more in price, which would let him buy in the area he wants to be in. So I think you'll see some of that as well. So um, kind of big picture, I think you're going to see a lot of policy that will be geared towards lowering inflation, lowering interest rates, lowering the cost of goods and services, kind of affordability overall. I think that's going to be their big push. I think it'll be a bigger push than it was last year. I think rates will get into the upper fives in the first quarter of next year. I think home prices are going to go up. And it's been interesting to look at the last few years, like during COVID, home values in the South increased significantly, and up north, they were pretty flat. In some areas, the home values had declined. And the market has completely shifted over the past few years, where if you look like up north, like in the Northeast, right, they're facing areas with limited inventory and home values are still rising. Like our headquarters is in Cleveland. Cleveland historically has not been a great real estate market, but home values in Cleveland are actually improving and doing better than Florida, Georgia, North Carolina, Tennessee, Texas, Arizona, southern states. I think the southern states will balance out a little bit more this year, and I think the end of home price decline probably ends in 2026 because supply and demand kind of swings back in the favor of sellers and price stability. So, all right, so that's good here at first. So, and paying, yes, I think even in Florida, I think it'll be really interesting for those of us in Florida, what DeSantis can do. And this is his last year in office. There's a the governor in Florida, every fourth year is during the presidential midterm election. So I think DeSantis will make a big push to do something with property taxes in Florida. And if for those of us in Florida, if property taxes come down or cut altogether, that improves affordability significantly. So that money's going to have to come from somewhere. So it'll be interesting to see where they kind of shift things around. Um, it seems like the proposal is to reduce property taxes or eliminate them on homesteaded property in Florida, which means, and like 80 or 90% of all property taxes are commercial. So it's actually not as big of a hit to the state budget if like homesteaded property isn't paying property taxes. I looked it up the other day, like the office building, like literally the way I'm pointing on Park Avenue, for those of you that don't know Orlando, where the Starbucks and Cola Banker are, that building's property taxes are $250,000 a year. It's like I don't know what that's worth, 10 or $20 million building. So how many houses, does it take to have that much in property taxes? So, but I think that'll have an impact as well in Florida. It's specifically if property taxes come down. All right, I want to shift gears. I want to just show you guys one or two things, and there's one quick topic I wanted to mention that came up last week, and I want to make sure that you all know how to kind of properly advise your clients. So we had a customer that was trying to get a VA mortgage, and they let someone assume their existing mortgage. And if you let someone assume your existing mortgage, especially if it's VA, you have to make sure that your entitlement is restored. Okay, so what is your entitlement? Essentially, VA says that your entitlement allows you to have 100% financing up to the conventional loan limit. And you can actually go above that. There's not a limit anymore. But So the conventional loan limit is 832,750 in 2026. If I have a $432,750 VA mortgage currently, I can get another VA mortgage for $400,000 with no money down. If I take the two mortgages and add them together, I just need to stay underneath the conventional loan limit. A lot of people don't know that, but lenders do. So like we see that all the time. However, um, let's say you let someone assume your mortgage. So in this case, we see people like keeping a house and renting it when they're maybe get a duty station transfer, um, and they own a primary home, they rent it out, they move bases, they get another VA mortgage. You can do that. That's fine. But if someone sold the house and let someone assume the mortgage, just like if they kept a house and rented it, their entitlement would not be restored if the person buying the house wasn't a veteran. And so we had a client here recently in one of our branches that was trying to get a VA mortgage with no money down, let someone else assume a mortgage. That person didn't take our veteran client's entitlement, and our person then was limited on how much of a house they could buy with no money down. So just kind of buyer beware. If you have a seller that wants to sell and let a buyer assume the loan, the key term is make sure the buyer takes the entitlement over. You really don't want to let your seller sell to a non-veteran because then they don't get their entitlement back. It stays with the non-veteran who purchases the home. So, and we're starting to see more and more of that. And if you're selling a house and your rate's 2.5%, it's pretty attractive to be able to offer that. Okay, the last thing I've got here, I just want to pull up the charts real quick and then we'll let you guys jump off. So we had nice little run the last couple of weeks. So bond pricing has been improving, and rates have come down a little bit. If you look at this black line here, okay, and I've shared this before. So this is what's called a ceiling of resistance. And what that means is for the bond market to continue improving above that threshold, something has to happen. There's got to be a catalyst, some kind of news that pushes us above that. And when bond pricing goes up, rates or yields go down. So let's look back at the last 1 year, and you can see right where we are today. We're about as high in bond price, which means as low as rates as we've seen in quite some time. We got there a little bit in October, we got there a little bit in September. Let's go back over the past 2 years. Kind of this same black line resistance level, we reached it in the fall of 2024. Um, and if we go back the last 5 years, okay, so this is going back to the end of 2020, you can see this black line here. So there's end of 2024, and then we saw rates in that range for much of 2023. But essentially, interest rates today are about as good as they've been since really the end of 2022 when rates started going up. And there's been times where rates went up and then came back down to the level that we're at today. That's happened 3 or 4 times over the past couple years, and rates haven't been able to break through that what's called ceiling and continue moving lower. So you can see it's happened a couple times this year, a couple times last fall, a little bit in 2023. And you saw in 2022, this is when the market started selling off, bond prices fell, rates went up, and you can see here rates bounced higher off of that. So it was called a floor of support then. Now it's called a ceiling of resistance, meaning that in 2022, this kept rates down. Now it's keeping rates up. And so something's going to have to happen for the bond market to push through that ceiling of resistance and rates continuing to drift lower. And just kind of view this is like in the low sixes, right? Like that's about as good as rates have been on a 30-year fix for the past couple years. Let me go back to the last 6 months. And you can see that we've been riding along this line really for a few months now. And we were flat because of the government shutdown. There was a lack of data being released. The market really wasn't moving because there was nothing to react to. But at some point, rates will bust through this ceiling of resistance, which means bond prices go up, rates will go down. but what's the catalyst going to be that's going to cause that? It could have been the really light inflation numbers we got last week or 2 weeks ago. I think the market kind of shrugged that off as like, yeah, I'm not sure if we trust the data. Was it compiled accurately during the government shutdown? January's inflation numbers become even more important because the market will trust that data. We'll have a Fed meeting in January, and the president might nominate a new Fed chair in January. And so, is January the month where we see a breakout and rates either bust through or do they get pushed back and move higher? Probably at some point in January. So I think you'll see a flat market for the next week or so. But once we get into January and the economic data starts rolling in, get your seatbelts on. It could be bumpy. Hopefully, it's bumpy in the right direction. But at some point, rates need to bust through this ceiling, which has been really difficult. So it's going to take some major news, like a second month of good inflation. So we'll talk more about that next week in the coming weeks, and we'll let you know when those reports are released in January. But that's really what we're watching for is not a lot the next couple of weeks, but middle of January, things could start to move in our favor. With that, everybody, have a great day. Have a great rest of the year, and we will see you guys next Monday. Thanks, everybody.